Hi, my name is Susan White. I'm a teaching professor at the University of Maryland, and I'm going to talk about some issues in corporate finance today. In particular, first I'd like to talk about corporate governance. Corporate governance is a set of principles that a firm can use to make sure that its assets are being used effectively and that its managers are being held accountable. Now that accountability is something that's very important these days. It's pretty difficult to pick up a Wall Street Journal or a Business Week or listen to CNN and not hear something about the many corporate scandals that have been happening in recent years, and we're still hearing about some of those same scandals, about Enron, about WorldCom, about Tyco, and many more that followed after that. In large respect, because of Enron and Enron's bankruptcy and the loss of money in the pension funds and simply the fraud that was perpetuated on the shareholders, the Sarbanes-Oxley Act was passed the following summer. The Sarbanes-Oxley Act has had big implications for corporate governance. Sarbanes-Oxley also, I might add, is referred to as the Full Employment Act for accountants and lawyers. It certainly has created more business for the people who are in the business of monitoring what corporations can do. What I'm going to be talking about are some of the general principles of corporate governance. What an analyst can look for in determining whether or not a company does have good corporate governance. Now, this is important because studies have shown that corporations that do have good corporate governance principles tend to be more profitable. So the market recognizes when a company is running itself well and rewards that company with higher returns because that company is running more efficiently and more effectively. Now, what I'd like to do before I get into some of the principles of corporate governance is talk about the corporation. The corporate form is the most dominant form. We have more revenues coming from corporations than from any other business form. There are a number of really good reasons for that to be the case. One is capital. It is far easier for a corporation to raise capital. They're bigger, they have more sources of capital, and they can get the money that they need to keep on going. Resources. A corporation is also going to have access to more resources. What the corporation can do, because of its size, is specialize. Rather than having someone who's responsible for all aspects of the company, you can have specialists. This person is in charge of the production. This person is in charge of sales. This person is in charge of finances. So it allows the corporation to be more efficient and more effective. And production, the corporate form tends to be superior in terms of production, once again because the corporation can draw on more resources and be able to more effectively use what it has. Now, in terms of corporate governance, the main objectives of a corporate governance system are to reduce or eliminate conflicts. And let's look at this point for a moment. A firm has stockholders, but a firm also has stakeholders. And in fact, the stakeholder view of the firm is becoming more prevalent. The stakeholder view of the firm says, yeah, there are shareholders, and they're important. We need to look out for the interest of shareholders. But there are also other stakeholders who have an interest in the firm. There are managers, there are employees, there are customers, there are suppliers, there's the local community, there's the government, and there are bondholders. All of these groups are stakeholders in the firm. They all have a concern about what the firm is doing. And in fact, interestingly, some states have mandated that the board of directors is required to look at the interests of stakeholders and not just look at the interests of stockholders. Traditional finance theory says it's stockholders that count. Every finance textbook that you ever pick up will say that the goal of the firm is to maximize the wealth of the shareholders, which they accomplish by maximizing share price, which they accomplish by choosing all positive net present value projects. The idea about stakeholders says, yeah, you want to do well by your shareholders, but you also need to look at the other parties that are involved with the corporation as well. Now, looking at a corporation, if you have a closely held corporation, a corporation that has only a few shareholders, or maybe a single owner proprietor, you don't have to worry as much about potential conflicts. If you are the owner of your company and you are the only employee of that company, by definition, everything that you do pleases the owner because you're the owner. So you don't have many conflicts that you need to worry about. It is as the corporation gets larger and larger and has a more diverse shareholding body and has more groups that it interacts with that you have to worry about potential agency conflicts. Corporate governance is designed to help reduce, or if you can, totally eliminate these conflicts. The other objective of corporate governance is to ensure that there is effective use of assets. I mentioned earlier that there have been so many accounting scandals. Well, in those cases, the assets were not used effectively. Had there been more effective corporate governance, had there been a board of directors that stepped in and said, no, what you're doing is wrong, you can't do this, then less of those firms' assets would have disappeared. As it is, a great deal of value, corporate value, was lost because of mismanagement of the firm's assets. While corporate governance systems differ, there are some general principles that you're going to want to look for in an effective corporate governance system. First, you want a system that's going to define the rights of the shareholders and the other stakeholders. You want to explain what responsibilities managers have and what responsibilities directors have, and in particular, what are their responsibilities relative to the shareholders. You also want to explain how managers and directors are going to be accountable for their performances. You want to be able to treat managers and directors and shareholders fairly. You want to be transparent and accurate regarding operations, risk, financial statements, and managerial performance. So these are the basic principles that you're going to look for in a corporate governance system. Now, before I go into more detail about what are the good principles, what are the good things to look for, what are the bad things to look for in a corporate governance system, I'd like to explain about the different forms that a business can take. Businesses can be incorporated as corporations. They also can be sole proprietorships, or they could be partnerships. A sole proprietorship is pretty much just as it sounds. You have a single owner-operator of that firm. Now let's look at some of the advantages and disadvantages of a sole proprietorship. First, for a sole proprietorship, it is easy to form. If you want to own your own business, all you do is say, I want to own my own business, and that's it. There are no forms to fill out, no regulations that you have to meet, no rules. You simply have an idea and you start carrying out that business. Now, all you have to do, as far as the IRS is concerned, if you own your own business, is fill out an extra schedule, Schedule C, on your income taxes, which states, what are your revenues, what are your costs, and as usual, it's the IRS, so there are a lot of rules about what you can deduct and what you can't deduct. But that's it. You just fill out an extra schedule on your personal income tax form, and you are a sole proprietorship. There are more sole proprietorships than any other business form in the United States. In terms of the numbers, there are more sole proprietorships than anything else. Now, one of the big advantages of a sole proprietorship is no corporate taxes. All of the income of a sole proprietorship is passed through to the sole proprietor, no corporate taxes, so the sole proprietor simply pays personal income taxes on all of the income from that sole proprietorship. And while I can somewhat quantify these advantages, easy to form, few regulations, no corporate taxes.